Revenue is considered as one of the major income from the operations or from the activities of an entity, and therefore how to account for it is very important to both management and shareholders of the entity. Today we are going to look at how to account for revenue, and its treatment have been established in the International Financial Reporting Standard 15, that is revenue from contracts with customers. Before the establishment of the IFRS 15, the two standards, that is IAX 18, which is revenue, and IAX 11, which is contract, was combined to establish this IFRS 15. Before we can better understand the concept and principles established in IFRS 15, we first have to look at the definition of some key terms. So first we are going to look at what is a revenue, and then we look at what is a customer, who is a customer, and then we look at probably what is a contract. So we are basically looking at the definition of these key terms. So when we take revenue, we are saying that it's an income that arises from the ordinary activities of the entity. So any income that is arising from the ordinary activities of the entity is considered as revenue. So remember that there are sometimes an entity may sell property, plant and equipment, in other words, fixed assets, and may gain some amount of money or some proceed from that disposal. That is termed as what? A gain, but not a revenue, because it is not happening as an ordinary activity of the entity. Then again, when we say customer, we are basically looking at a party who has contracted an entity, and this party obtains goods and services that are the output of the entity. So this party is a party who has constructed an entity to obtain goods and services, and those goods and services are basically the output of that particular entity. And basically, when we say contract, we are saying that it's an agreement between two or more parties which give rise to enforceable rights and obligation. So these are the definition of the key terms. IFRS 15 is very simple because it has established 5-step approach in recognizing revenue, and then also how to account for contract cost. So the standard is basically categorized under two main headings: that is 5-step in recognizing or accounting for revenue, and how to also account for contract cost when they fall due. So basically we are going to go through the 5 steps or 5 approaches that one is supposed to use in accounting for revenue. So the first, I'm going to look at 5 steps. So we have step 1 to step 2, 3, 4, and then step 5. So after we've gone through these 5 steps, any practical question that's fall due under this particular standard, you should be able to solve it. So with the step 1 is to identify the contracts with the customer. So the first step is to identify the contract with the customer, and then the step 2 is, I'm first going to mention all before we take them one by one and look at what goes into each of them. So the step 2 is basically to identify the performance obligation. So here we are looking at performance obligation. Here we are looking at the contract. So once you've been able to identify the performance obligation, then you determine the transaction price, and then after determining the transaction price, then you allocate the transaction price, and then here you recognize revenue. So after these 5 steps, you should be able to account or deal with any question that falls under this particular standard. So the first one is to identify the contract with the customer. we identify the performance obligation, we determine the transaction price, and then we allocate the transaction price to the performance obligation, and then we recognize revenue when or as and when performance obligation is satisfied. So that is the 5-step approach in recognizing revenue. Now let's take the steps one by one and go deeper into them and see what's the standard prescribed in each of the steps. Now step 1, which has to do with identifying the contract with the customer, we want to see if truly a contract exists between an entity and a customer. Okay, does any contract exist? Does any performance or any activity give rise to an enforceable right on the part of the entity? So the standard gave 5 criteria that is supposed to be used to determine whether there is a contract or there is no contract. So remember that this criteria helps you to know whether there is a contract between a particular customer and an entity or there is no contract. Now the first criteria has to do with the parties have approved a contract and are committed to perform their respective activities or obligations. Is that okay? So that is the first step, or the first criteria. That is, the first criteria is the parties have approved the contract and are committed to, perform their respective duties or obligation. And then the second criteria has to do with that the entity has identified each party's right. That is the second criteria. And then the third one is that the entity has identified the payment terms. So whether they are going to pay with cash, whether they are going to use non-cash payment, the entity is able to identify the payment terms. Fourth one is that the contract have a commercial substance. The contract have a commercial substance. This simply means that the future cash flow of the entity should be affected by risk, by timing, and any other activities. That is that the contract must have a commercial substance. And then the last one is that it should be probable that the entity will collect its consideration from the contract, or from delivering each part of the promises. So if all these 5 criteria are present, then we say there is a contract. Once one of them is absent, then we say there is no contract. So the first one has to do with the parties have approved and are committed to perform their respective obligations. Then the entity has identified each party's right, and then they also have identified the payment terms. We say that the contract is of commercial substance, and we are saying that it's probable that the entity will collect its consideration. So that is basically what goes into step 1 of the 5 steps approach in recognizing revenue. Now with the step 2, we are supposed to identify the separate performance obligation in the contract. We are supposed to identify the separate performance obligation in the contract. Now what we mean by separate performance obligation is that sometimes the performance obligation, when we say performance obligation, is basically promises made or promises by the entity to deliver goods and services. In fact, it can be distinct goods and services to a particular customer. So we are saying that it is the promise to deliver goods and services to a customer. That is basically the performance obligation. Once we've entered into a contract, then it is required of the entity to perform or to deliver each side of the contract, whilst the customer also deliver each side by providing the cash or the consideration to the entity. So the performance obligation is basically the promises that you give to the customer that you are going to deliver goods and services to that particular customer. Now, here there are 2 things you are supposed to notice. Sometimes the customer may deliver performance obligation which are distinct, and then in other words, which are bundle. Now the difference or the meaning of this is that, assuming that we are selling a computer, and then you said that when you are done you provide technical support. Okay, so you are selling a computer to a customer and you are going to provide a technical support. You see, this is a separate performance obligation and this is also a separate performance obligation. So this one, we call them as what? A distinct. But anytime this and these are provided together, when we cannot separate it from one to the other, from one performance obligation to the other, when we cannot separate them, we cannot distinguish between these two performance obligations, then we say is what is a bundle which is provided or which is performed using a normal pattern. Now, one thing you're supposed to note is that it's not always the case where we will see the goods being provided to the customer. Sometimes the practices of the entity, the statement issued by the entity, the policies that have been established by the entity may create an expectation that the entity will supply or will provide goods and services. Okay, explicit. So this one that we can see is explicit. So the second one that I've mentioned of is supposed to be the implied, because it's not something we say, but because of your practice, it implies that you are going to deliver goods and services. Now, when this performance obligation is done by the entity, okay, when this performance obligation is done by the entity, then we say it is done by a principal. But when this performance obligation is done on behalf by the entity, then we say it is done by what? By the agent. Now, if a performance obligation is performed on behalf of the entity, which is the agent is performing, the performance obligation on behalf of the entity, then we say that the entity or this particular agent is supposed to recognize revenue, and that revenue that the entity is supposed to recognize is supposed to be what? A commission. The commission, but not the actual sales. So if an agent is making sale on behalf of a particular entity, then what revenue the agent is supposed to recognize in its books is supposed to be what? The commission that is supposed to be received on the sale, but not the revenue or the actual proceed coming from what? From the sale. So to understand our agent, selling on behalf of the entity, then we are saying that the particular revenue to be recognized by this particular agent is supposed to be what? The commission. So let's look at the question on the screen. We said John's revenue includes $2 million. So $2 million for goods it sold acting as what? Agent to Ruth. So John is an agent here, and then Ruth is the entity or the principal in this case. So John is acting on behalf of Ruth. Okay, so he said he sold goods acting as an agent to what? To Ruth. Now, John's earn a commission. So anytime you make these sales, you're going to earn a commission of 20% of the sales, and he remitted the differences of 1.6. So he made a sale of this, and his commission is 20%, but he remitted the 1.6 billion included in cost of sales to Ruth. So after everything, he sent 1.6, which he included in books in the cost of sale, $1.6 million as cost of sale in whose book? In John's book, okay, as a remittance to Ruth. So how should the agency sale be treated in John's statement of profit and loss? So if you look at this question critically, you can see that John is committing an error over there, because remember that the only revenue that is supposed to go to the agent is supposed to be what? The commission of 20%. But in this case, John has included in his revenue 2 million. So he has included in the revenue 2 million. But how much is John supposed to recognize as revenue? It's supposed to be the 2 million multiplied by the 20%, which is going to give him 0.4 million. This is what is supposed to recognize as what? As revenue. But John has gone ahead to recognize all the money as what? Revenue, and then remitted and send this one in the cost of sale, which will reduce this amount by what? By 1.6, which will be left with the 0.4. But it is wrong. So the correct treatment is that we have to remove an amount from the revenue, which will be left with what? The 0.4. So here, remember that when you want to write a revenue in the books or in the P&L account, is supposed to be what's credited. So in this case, you are going to debit revenue with 1.6 million. So we debit revenue with 1.6 million. Why are we debiting revenue? We are doing this in John's book. Remember, he said, how are we going to treat this in John's, statement of profit and loss? So we are going to debit revenue because it was previously credited with 2 million. So we debit 1.6 so that it will now be left with what? The actual commission that is supposed to be what? Received on the sale. Then when you come to the cost of sale, we have cost of sale there, which is this amount was not supposed to be in John's book in the cost of sale because it has nothing to do with the cost of sale in John's book. So therefore, what they are supposed to do, this amount was actually debited in the cost of sale in John's book, so you are supposed to credit it. So you credit the cost of sale, that is the same of what? 1.6, so that this balance in the cost of sale of John becomes what? Becomes 0. So therefore, we will realize that the 0.4, which is the commission, will be what? Remaining in the revenue of John. So this is how to treat. Remember that it is only the commission received by the agent that is supposed to be treated as what? Revenue, but not the revenue itself that is what is generated from the sale. So we are moving to the third step. That is the 5-step approach in recognizing what? Revenue, and the IFRS what? 15. Alright, so the third step is to determine your transaction price. That is the step 3. To determine your transaction price. The transaction price is basically the consideration, the amount of money that the entity is entitled as a result of what? Performing its performance obligations, or as a result of delivering goods and services to a customer. So any amount that you are entitled to is referred to as what? Your transaction price, and in this case is referred to as what? Your consideration. Now, this consideration comes with one or two, issues. So for us to determine the transaction price, it comes with one or two issues or the same consideration. So the first you are supposed to look at is what? You are supposed to look at what we call variable consideration. This variable consideration basically has to do with the bonuses, the incentives, the taxes that comes with the customer paying what? The entity. So there may be variable consideration and it must be taken into consideration. So before you can take the transaction price into consideration, these few things must supposed to be taken care of. Now the next one has to do with significant financing component. And this is basically time value of money. And this is when the customer is buying the item today but promises to pay at the later part or at the later date. So where the contract date is different from the day that the entity is going to collect its consideration, then this gives rise to what we call significant financing component, and we are supposed to account for it using what we call finance income, and then also looking at the receivables. Okay, so this is because of time value of money, because the money today or $1 today will not probably be the same tomorrow. So probably you are supposed to take this into consideration as well when they are dealing with the transaction price. You will solve a question on this particular one, which will help us to establish our understanding of the concept properly. Then we also have what we call non-cash consideration. Then the last one has to do with consideration payable to customer. Now, with the non-cash consideration, basically we are looking at a situation where a customer is buying something from the entity but is not going to pay with cash. Maybe you want to pay with exchange of shares, or maybe you want to pay with another item, a loan or something, a loan note, share certificate, or anything that is not of cash. Then the last one is that sometimes the entity may receive money but may not perform an obligation which equals to that particular money. Anytime that happens, then we are supposed to refund the rest of the money that does not meet the performance obligation of the entity. And that anytime you want to give back the money to the customer, we call it what? Consideration payable to a customer. Some people also refer to it as what? Refund liability. Refund liability, because you didn't perform any obligation that warrant that you should recognize that amount in your books. So you are supposed to send it back to the customer. And anytime you are supposed to do that, it's what we call refund liability. So let's quickly solve a question on how we treat this significant financing component or time value of money in case they fold you in your question. Right, so with the question on the screen, we can see that there's a Ronas enters into a contract with the customer to sell an equipment on 31st December 2001. So let's take note of the question and the year. So this one is 31st December 2021. That is when the contract is taking place for a consideration of $1 million. Okay, so and then the control of the equipment was transferred to the customer on that same date. But the price stated in the contract, which is $1 million, is due on 31st. So the entity is going to receive the amount on 31st of 2023. So the contract is on 2021, but the due date, the date that they are supposed to receive the consideration, is going to be 2023, and this give rise to what we call significant financing component. Anytime this happens, we are supposed to take into consideration time value of money in recognizing revenue in the books of the entity. Now, so this is how we go about the treatment. First of all, we are supposed to first discount the amount. Now look at something. Look at the contract date. The contract date is not beginning of the year, but at the end of the year. So anytime such a situation happens, then in the first year there will be nothing like finance costs. There will be no finance. So in this case, it's going to be finance income rather, because the entity is going to be the one receiving the money. So finance income in the first year. By assuming that this particular contract was happening on the first, on the 1st of 2021, that is 1st January 2021, then we are saying that we will take into consideration a finance income, because it will take 1 year before the year will end. But in this case, the contract is happening at the end of the period. So we only take into consideration the receivable, the revenue of that particular entity. So first, we are supposed to discount, the consideration. So the consideration was 1 million multiplied by 1 divided by 1 plus 1, 0.1, because this is the percentage, which is the 10%, raised to the power 2. Why 2? We are looking at the number of years it will take the customer to pay back the amount. Look at here. This is the end. So there is the end of the period. So 2022 is 1 year, from January to December 2022, and from January to December 2023. So 2 years. So if you discount this properly, you are going to get an amount of 826,446. So that is going to be the receivable or the revenue in the first year. Remember that this amount is just like a credit sale. If you go to the P or L of every entity, we have revenue or sales, and these sales comprise credit sales and then cash sales. So here we are looking at what the credit sale, which is the same as what in this case we are going to call it what receivable. Right. So in this case, we are going to, so that is going to be in 2021 31st. 2021 31st. We are going to debit our receivable of this amount, which is the 826,446. Alright, so like I said, we are going to debit our receivable with the 82446, and then we are going to credit our revenue, which is the same as revenue interest, which is the 826,446. So when you go to the balance sheet, this is happening in the P or L account. When you go to the balance sheet, this is going to be treated as what? Your receivable. This amount is supposed to be treated as what? Your receivable. Because the money is not going to be received in 2021, but it's going to be received in 2023, we are supposed to what? Unwind the present value, this present value figure. We are going to unwind it and take whatever we get on this particular figure as what? Our finance income. What am I saying? What it simply says means that in 2022, my finance income is going to be the 826,446 multiplied by 10 and this will give me 82645. 82645. 82,645 thalers. That is going to be my finance income, and this is going to be treated in the P or L account as my finance income. There will be nothing like your receivable again, because you have already recognized this in 2021. So this is 2022. They are going to recognize this as your finance income. Then when you go to the statement of financial position, your receivable is now going to be the 826,446 plus this finance income over here of 82645, and this is going to give us how much? 909091. Okay, 909091. This is supposed to be our the receivable in the balance sheet. That is supposed to be 2022 receivable. Okay, so receivable in the statement of financial position, that is for 2022. Now we are going to 2023, which is the last year, or the year in which the amount is supposed to be paid by the customer. So in this case, again, we are supposed to calculate for our finance cost, but this is supposed to be on this value. So now the receivable is 909091 multiplied by our 10%, and this is going to give us 90909. So 90,909 thalers is supposed to be in 2023. So when you go to the statement of financial position in 2023, then our receivable is supposed to be the addition of this and the previous receivable. So the new finance income. So this one will be treated in your P&L account as your finance income, and then this plus this will be treated in your statement of financial position or your balance sheet as as your receivable at the beginning. So receivable. So if you add this to this, you are going to get the 1 million, because at the end of the period, if you add this your finance income to the previous receivable, you should get the amount of consideration in the particular question. Now remember that the business is going to receive cash over here. So here we are going to We are going to credit our receivable and then debit cash, so that this amount of receivable will be taken from the books of the entity. So at the last period, we are going to, so at the end of the last period, we are going to debit cash of $1 million and then credit our receivable of $1 million, because we are receiving cash at the end of the period. So this is how you treat a significant financing component. Remember that when the contract date and the payment date are not the same, then this gives rise to what we call a significant financing component, and you're supposed to find the present value of that consideration and then unwind it, and unwinding it will give rise to what we call the finance income. All right, so understanding step 3, that is determining our transaction price, and we want to move to step 4 of the 5-step revenue recognition and the Ifrs 15. With the step 4, we are saying that we should allocate our transaction price to the performance obligation. This is very simple. This, if you come to step 2, and then we have performance obligation over there, and then we come to step 4, we are supposed to allocate our transaction price to our performance obligation over here. Now when you come here and we are having a distinct goods and services, so like I gave earlier on, we have a computer, and then a technical support. Which are distinct. Okay, this is maybe 1 year. 1 year, you provide this for the next 1 year. Then we are saying that when you come here, maybe the consideration is $420, and they say that the computer is $300, and this place is $120. So when you come to step 4, you are supposed to allocate this whole transaction price toward the performance obligation over here. But you doing step 4 depends on what happens in step 2. If here these two things are combined, then here we don't have to allocate. We just give all the total transaction price to that particular performance obligation. But if they are distinct, like we have here, we have computer separately performed and we have technical support separately performed, then when you come to step 4, which is the allocation of the transaction price, we have to also separate the transaction price to each performance obligation. In allocating our transaction price to the performance obligation, it must be in the proportion of a standalone prices. A standalone selling price. So it's basically a selling price that an entity will sell a separate or a different goods separately to a customer. Okay, so the price or the selling price at which a customer will separately sell a distinct goods to a customer. Now remember that we are supposed to have an observable price, that is a similar price that the entity will sell that particular goods to a customer. But in the case where there is no observable price, then we are supposed to estimate the standalone, selling price. Okay, that is about the allocation of our transaction price to the performance obligation. Here too, there is another issue, and this issue is what we call discount. Now, with the discount, we are saying that sometimes, because the entity is going to sell with a standalone selling price, this will give rise to a discount. Now, remember that if a discount arises, it is supposed to be shared in accordance to your performance obligation. If you have separate performance obligation and then you have been told that one of them enjoys discount and the other does not enjoy discount, then all of the performance obligation that enjoy discount must be attributed to that discount. But in the case you were not told, then you are supposed to share it on a pro rata basis. That is about the discount. Now, for us to better understand this particular concept, we are supposed to solve a practical question which will augment our understanding. So let's look at the question on the screen. Ronas sells a machine and 1 year's free technical support for $100,000. So we are doing two things over here. We are selling a machine, and then we are also providing technical support. And all this goes for $100,000. Now let's proceed. They said it usually sells the machine for $95,000, but does not sell the technical support for this particular for this machine as a standalone product. So we know that usually the machine is being sold at $95,000, but this one we don't sell it on a standalone price, but does not sell. So other support services offered by Ronas attract a markup of. So we have been told that if you want to sell this, it attracts a markup of 50%. So a 50%, and we are told that it is expected that the technical support will cost. So it's going to cost this amount. The cost of this technical support that we are going to provide to the customer is going to be $20,000. It's going to be $20,000. So in this case, since we don't know the observable price, we are supposed to determine or estimate our standalone selling price for the technical support. In doing that, we are supposed to add the profit element of this to the cost. Remember, this is cost and this is 50%. So we multiply. If you want to know the profit element, so let's do it here. So the profit, we want to determine the profit. So here this is the cost. So we want to know what is the selling price. And remember that selling price is going to be the cost plus your profit. But we don't know the profit, but we are told that there is a markup of 50%. The markup is charged on what cost. So we don't have to change it to margin. But if this were to be selling price, that's when you have to supposed to change this margin before we attribute it on this one. So we are going to multiply our 20,000 by our 50%, which will give us 10,000. So our selling price in this case is going to be the 20,000 plus the 10,000, which will give us $30,000. Now, so if you want to add the machine and technical support, in this case, it's going to be the 95,000 and then the 30,000. So this is going to give us a selling price of 30,000 plus the 95,000, which will give us 125,000. But what amount do we actually receive? The amount we received was what? 100,000. So this 100,000 was received. So this should tell you that there is a discount of how much? There is a discount of 25,000. There's a discount of 25,000. Now, how do we attribute this 25,000 discount to the technical support we provided separately and also to the machine that we also provided separately? And this is how it goes. You are supposed to share this one on a pro rata basis. So this is how we are going to do it. So let's have our machine over here, and then let's have our technical support over here. Okay, so the first one is the machine, which was 95,000. So divided by the 125,000 multiplied by the 100,000, and this will give us a dollar of 76,000. So here we are sharing the we want to know how much discount is on the machine and how much discount is what on the technical support. In this case, we didn't tell us specifically that one of them enjoyed discount and the other didn't enjoy discount. So in the case where the question is silent, then you have to share the discount, on a pro rata basis equally to what each of them. So the second one is going to be the 30,000, all divided by the 125,000 multiplied by the 100,000, which is the consideration in the question, which is going to give us 24,000. So if you add these two, you should get what your consideration received in the question. So this is basically how to deal with what a discount question. Remember that if they said the machine will not enjoy a discount, then all the 25,000 is supposed to be attributed to what? To this one. In this case, we are not supposed to share it. In the same vein, if only this one is enjoying the discount, then everything is supposed to be attributed to the machine. So now that we understand the concept and principles in step 4, we want to quickly look at step 5, which is the last step in the revenue recognition. Then we will be left with how to account for our contract cost. Now with the step 5, we are saying that we should recognize revenue. Step 5, we should recognize revenue when or as a when performance obligation is performed. So in this case, once the entity has performed its performance obligation or has delivered its performance obligation or has satisfied its performance obligation, then the entity is supposed to recognize revenue. Now, one thing you're supposed to remember is that the revenue can be recognized, or a performance obligation can be performed over time or at a point in time. So we can perform our performance obligation over time or at a point time. So in this case, at a point of time means just once. You are going to perform the performance obligation just once. Like you want a computer and I provide the computer for you. It's just once, contract, once performance obligation at a point of time. This doesn't come with any issue. But anytime you are going to provide we are going to satisfy the performance obligation over time, that means at each point, at each year end, we are supposed to account for revenue at the progress of that particular contract. And this actually happens when you are dealing with the manufacturing of a manufacturing contract. Now there are 3 criteria for which we should say that there is the contract is performed over time. So if those criteria are present, then we say the contract is performed over time. But once they are absent, then we know that they are performed at a point of at a point of time. So the first criteria is that the customer simultaneously receives and enjoys the benefit that is being provided by the entity's performance, the entity performance obligation, or the entity's performs. So when the customer simultaneously receives and then enjoys the benefits provided by the entity, then we say there is over time. That's the first criteria. And then the second one is that the entity's performance enhances or creates an asset which is controlled by the customer. So when the entity's performance obligations or performs creates or enhances an asset which is controlled by the customer, then we say there is a contract that is being performed over time. And then the last criteria has to do with when the entity performance does not create an alternative asset for the entity. So when you are performing the contract, but it does not create an alternative asset for the entity, and it is probable that the entity the entity has an enforceable right to enjoy the consideration, then we say the entity is performing that particular contract over time. So when these 3 criteria are present, then we say the entity is performing the contract over time. Now, once a contract is performed at over time, then at the end of each year, we are supposed to determine the progress of the contract and then only recognize revenue to that extent. And we have two methods of doing that. We have the input method, and we also have the output method. So with this, we will go deeper into it when we are dealing with what? The contract cost. So in total, this is basically about the 5-step of recognizing revenue under what? IFRS 15.